Good morning. Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. And we'll cover some key topics and risks for investors tied to developments around the world. And we're going to take your live questions from the chat on YouTube. So you can ask us what's on your mind at any time. You can just enter it into the chat and we'll get into those questions in just a few minutes after we share some of our latest insights. Now, we've got a lot to cover as always, but first, we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations. We talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why, though we don't provide an outlook for specific stocks. And of course, things can and do change, so all the thoughts we share are subject to change as well. And investing has risks, of course, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team here at Charles Schwab. Good morning, ladies.
Jeff, good morning, everybody.
Good morning, everybody. As usual, I will be watching the chat and the questions closely, and we will get to those in just a little bit. Jeff, can you go ahead and kick us off with a quick rundown of what we're watching this week that could move the markets?
There's a lot going on this week, I guess, as every week so far this year. But this week we've got Germany's parliament voting on Tuesday, the lower house of parliament, on a massive spending increase and sweeping changes to borrowing rules to bolster defense and revive growth in Europe's largest economy. Germany's new chancellor has been racing to get amendments to the constitution passed, which needs a two-thirds majority by March 25th before the newly elected parliament is set to convene. That package, of course, includes a lot of spending initiatives and increasing defense spending as well in Europe. So something the market's been reacting to. We've been talking about European defense stocks for a while now, doing very, very well. And that'll be something to watch on Tuesday if that gets done. Looks like they're on track to make that happen. We've got central banks on Wednesday and Thursday, a flurry of them. Few changes, though, are expected in this environment of increasing macroeconomic uncertainty. On Wednesday, the Fed is going to announce its rate decision. A hold is the most likely outcome there for the second straight meeting. Now, the Bank of Japan is expected to maintain the target rate as well after they hiked by 25 basis points at their last meeting in January. And then on Thursday, the Bank of England is expected to hold after 3 cuts since August. So we got hold this week. We may see a cut by the Swiss National Bank. That's one of the sort of lesser watched developed market central banks. So we might get a little move there, but everybody else pretty much in the mode of hold for right now. Also this week, Congress is a district work week where they kind of go back and to their districts and see what's going on. And that could bring those lawmakers face to face with some angry constituents over some of the abrupt policy changes, along with a weakening economy. We got more data on that here in the U.S. this morning, retail sales. And of course, the weaker trend in the stock market, although I've got a little green on my screen this morning. Now, earnings reports are expected from some companies this week, those that have an off quarter end, so a fiscal quarter that doesn't line up with the calendar quarter. That includes FedEx, Nike, and Tencent. Those are the ones I'm going to be watching because they may offer some insight into how trade and shipping is faring amidst the Trump tariff war. So we'll have to see how that goes. Now, I talked a little bit about the German situation. I think that's probably the most important thing to watch in the first half of the week. Late last week, it appeared that Germany's new chancellor did, in fact, secure the votes needed to get the Green Party on board to pass those constitutional changes through Germany's lower house on Tuesday. Europe's stock 600 index got a real boost from those German headlines, looking like they were on track to do that. But it still saw its biggest weekly decline this year last week as worries about a U.S. economic recession hurt global investor sentiment. There's only so much decoupling you can see between Europe and the U.S. And with the U.S. slowing, even though Europe is improving, that was a bit of a drag, but not as much of a drag as we saw in the S&P 500. You see this chart here, a little red arrow there. You can see the top chart is for the stock 600. That's Europe's stock market. You can see it's the worst week, or maybe second worst week this year, versus the S&P 500 worst week in 2 years for the S&P 500. So really the cumulative effect of uncertainty and a slowdown in the economy and not sure what's next on the tariff front, certainly. All that has, of course, highlighted the turn in market leadership we've been talking about all year. And due to popular request, thank you, I've updated my shark chart showing the jaws may be beginning to close as international markets begin to outperform U.S. markets after a long cycle of U.S. outperformance may have come to an end. Of course, when the orange line is rising on this chart, that's when U.S. stocks are outperforming international stocks. When the blue line's rising, it's the opposite. The two lines are really mirror images of each other. But what we're starting to see here is just a little bit of a pullback there in that orange line so far. That could go a long way. That's sort of the point of all this. Yes, we've seen very strong international outperformance this year. Just looking at my screen, international stocks are up 12% this year. U.S. stocks are down 4%. That's a pretty big gap, but look how far they could possibly go here, as we've seen with these cycle changes in the past, where international outperforms, then U.S., and international, then U.S. So we could be embarking on a long period, potentially long period here, of international outperformance as those jaws begin to close, suggesting it might take a big bite out of portfolios of those investors that have not allocated out of a heavy overweight to international U.S. equity. So something to think about. And of course, leading the charge is the new Mag 7, the Magnificent 7, the 7 European defense stocks. Yep, tied to what I was talking about there in Germany. Those are now up nearly 40% this year, while the old Mag 7, or as Schwab's chief U.S. strategist Liz Ann Saunders last week referred to them as the Lag 7, not the Mag 7. They're down 13% this year. So look at this huge gap, up almost 40, down over 10. Just a massive gap between sort of the new Mag 7 and the old there. Continues to widen out, further highlighted perhaps this week by that vote on Tuesday in Germany allocating more to defense spending. Now, finally on this topic, before I bring everybody in, I got a question last week. Is it only because of the weakness in the Mag 7 that European stocks are outperforming? The answer is no. Europe's stock market leadership is not just due to the recent weakness in the handful of those Mag 7 stocks. Europe has been outperforming the U.S. on an equal weighted basis for years now. If you're a regular watcher of this show, this, by the way, is our 190th weekly episode. We've been talking about this for quite some time. European stocks, the average European stock, has long been outperforming the average U.S. stock. This chart here, we can see Europe versus the U.S. if we give each stock in the index the same weighting. We're used to indexes that capitalization weight stocks, meaning the more valuable the company, the bigger the weight it gets in the index. And so the Mag 7 have a pretty big weight. But if you just look at the average stock, meaning every stock in the S&P 500 gets the same weight, 1/500, and the same thing for the European benchmark, you can see what the average stock in the index is doing. And here you can see the average European stock has widely outperformed the average U.S. stock for the last 2.5 years now. In fact, really since the beginning of this bull market, we've never seen a period where U.S. stocks have outperformed European stocks on an average basis. So really important here. In fact, they've doubled the return of the S&P 500, the average stock in the S&P 500. And I think very few people are aware of this. And we've been advocating rebalancing portfolios towards Europe for the past few years. Finally, the data flow seems to be showing this is gaining some traction. So if you look at fund flows, they also suggest the European outperformance is being backed by a shift in investor allocation. So people starting to move money out of the U.S. into international stocks. European equity funds, ETFs and mutual funds have now seen the biggest 5-week inflow since 2015, according to data from EPFR Global tracks these fund flows. Meanwhile, U.S. funds suffer their biggest redemptions of the year, $2.5 billion in the week through March 12th. So a lot going on under the surface here. Investors are beginning to recognize the value in international stocks, allocating more towards them. At the same time, we're seeing much stronger outperformance there. So, Michelle, we've been discussing the outperformance of international stocks, Europe in particular, this year after really strong gains. Should we expect this to continue? I know I've just talked about that sharp chart, maybe a long way for those jaws to close. What are you looking at?
Yeah, I think that international has begun to be kind of exciting.
Okay. Yeah, we're going to go to a quick break. We're going to fix Michelle's audio problem. We'll be right back. Hey, welcome back, everybody. Michelle, we've been discussing the outperformance of international stocks, Europe in particular this year. After these strong gains, what do we expect from here?
Yeah, I think international has gotten to be a little exciting now. And the reason is that there's some change happening. We're seeing really kind of a defining moment happening in Germany, and you talked about that earlier today with the changes that they're hoping to make in terms of fiscal stimulus. And we talked about it last week too, but it really bears emphasis. The three largest parties in Germany's current government reached an agreement for a massive fiscal stimulus to invest in infrastructure and defense spending. And the reason it's so interesting is because they're doing this very quickly. It's a huge size that they're looking at. And the shift away from fiscal austerity is really a change. And it could break Germany out of stagnation and define the next decade for the country. And as you mentioned, it's not just the new Mag 7 companies and the MSCI Aerospace and Defense Index, or even the relative performance of the equal weight indexes. The European banks, for instance, are outperforming by 20 percentage points this year relative to US banks. That said, the international stocks have risen a lot, particularly those defense stocks, in a relatively short period of time. And yet the stimulus is going to take time to start and impact economic and earnings growth. So there's potential for disappointment along the way. That said, we know investors are underweight Europe and international as a whole. You saw in that shark chart, U.S. stocks have outperformed for at least a decade in terms of the main cap weight indexes. So we could see a shift in asset allocation that could really support gains for international stocks over a longer period of time. In the meantime, economic data in the Eurozone is surprising to the upside, while U.S. data has been surprising to the downside. And, the role here of business confidence is really important. We also talk about this sometimes as animal spirits. So there are anecdotal stories of businesses in the U.S. pausing CapEx due to tariff uncertainty. At the same time, in Europe, there's potential for businesses to get a lift if confidence about the future improves, and it could prompt them to invest and hire. And so it's probably a good time for investors to review their asset allocation and consider slowly adding exposure to international to the extent that they're underweight their longer term target, Jeff. I mean, it's also kind of interesting to think about maybe the possibility that a rebound in German economic growth could help China.
Yeah, that's interesting, right? There's a lot going on with some of the data here. You just mentioned some of the U.S. data coming in, some of the softness, let's just say. I mean, it's not terrible. Certainly, we're not seeing what would appear to be like a recession unfolding immediately here. Although, I guess some of the data, GDP Now forecast for U.S. from the Atlanta Fed is pointing to maybe flat growth here in the first quarter for U.S. GDP. But certainly some disappointing numbers here lately as the data continues to come in weaker than expected on the economic surprise indices. It's been better than expected in Europe. And I guess we've seen maybe more recent better than expected data in China as well. Is that right?
Yeah, that's right. We got the data for China they combined January and February together due to the Lunar New Year. And industrial production was better than expected, retail sales better than expected. So they're not seeing any impact of higher tariffs yet. And they have a lot of room, frankly, for a fiscal stimulus. And they're talking about maybe a consumption plan to boost household incomes. So there's more to see there in terms of China.
So we've seen the U.S. slow down, China pick up, Europe pick up. We used to say that when the U.S., sneezes, the rest of the world catches a cold, because the U.S. is such a big driver of global economic growth and demand. So there probably is a limit to this decoupling if the U.S. continues to slow down, but more of a soft landing in the U.S. is probably compatible with continued strong performance, both economically and from an earnings and stock market perspective, both in Europe and in the U.S. But one of the drivers of that is central bank policy, right? So speaking of this, Michelle, we've got a lot of central bank meetings this week. A year ago this month, the Bank of Japan made its first interest rate hike in 17 years, moving out of negative interest rates. But its second hike in August of last year was the one that really shook up the markets, including the S&P 500, since speculators in the currency markets were positioned for continued weakness in the yen, despite what seemed like well-telegraphed intentions of a hike. And so we saw this really abrupt unwinding of the yen carry trade at that time, really shook up the markets. What do you expect from the BOJ this year, and how much of a risk do its actions pose?
Yeah, I think it's good to maybe think about Japan and where they've been and where they're going. Unlike most major economies, Japan wants inflation. Now remember, they had 30 years of deflation, and that recall in a deflationary mindset, consumers postpone purchases in hopes of lower prices in the future, which slows demand and economic growth. It's kind of a negative cycle there. An inflationary mindset is the opposite. So inflation has been above the Bank of Japan's 2% target since April 2022, but the Bank of Japan is concerned about the sustainability of that because the initial increase in inflation was largely due to pandemic-related supply chain disruptions and the initial shift to goods spending. So what they really want to see is wage growth, and that's really the key for virtuous cycle for Japan to break free from deflation. Wages have been stagnant for decades, so the Bank of Japan is closely watching the annual spring wage negotiations. Last week, Japan's largest union group, known as the Rengo, which represents around 7 million workers, announced that they secured a pay gain of 5.46% on average. That's the highest since 1991, and it exceeded last year's 5.28. Now, excluding bonuses, this equates to a base pay gain of 3.8% on average, and that's higher than last year's 3.7%. Positively, workers at smaller firms also secured pay increases that were better than last year when the gains were more centered at the larger firms. We'll see final figures in the summer, and they'll be revised several times as more results come in. But the wage increases are expected to keep the Bank of Japan on its hiking path, even though we don't expect a change at this week's meeting. You know, the problem for the Bank of Japan is that wage increases have not kept up with inflation. So if we take into account inflation, real wages were actually down 0.3% last year, and that really is a pressure on consumer spending. Additionally, Japan faces some uncertainty from any potential global slowdown due to the trade war from the US. And if economic growth slows, it could be difficult for companies to continue to hike wages. So the Bank of Japan is likely to proceed slowly. However, the increased prospect that we're seeing this year of Japan raising rates and the US lowering rates has compressed the interest rate differential between the two countries. And that's prompting some strength in the yen. And the yen also tends to benefit from a flight to safety during times of volatility. But if we look at the very speculative positions in the yen carry trade, they've been reversed. And as you can see in the chart now, the red arrow on the bottom is when we had extreme net short yen, and now we have quite a different positioning with the red arrow on the top. You know, it seems to be consensus that people are long yen. Now, there could be some movement into Japanese assets from elsewhere longer term, but any kind of unwind from medium term and longer term positions, like for instance at Japanese pension plans, they would likely be more gradual over time, and we're not likely to see the shock that we saw of the unwind of the speculative positioning that we saw last August, Jeff.
So last August we were, speculators here very positioned on a continued weakening of the yen, borrowing in yen and investing in stocks like the Mag 7. Now we've kind of seen that reverse, right? We don't have that same kind of borrowing in yen in Japan at very low or negative interest rates and go long, risky assets. First of all, those Mag 7 stocks have pulled back quite a bit, but we've also seen a reversal in the views of the yen. So we don't have that quite the same leveraged near-term borrowing situation that would have to unwind very sharply and disrupt markets. So it seems like we seem to be safe from at least an abrupt yen carry trade unwind. Longer term, there's still a lot of borrowing in yen that's taken place over the last 17 years or so that may slowly begin to repay, or the pension funds, as you note, reallocating back towards Japan. But that'd be a slower process, as you note, as opposed to the abrupt margin calls that speculators were getting in the futures markets there back in August. So good to see that we don't have the same abrupt risk there in the markets should the Bank of Japan hike rates again, which they are probably likely to do here again this year. Okay, Heather, well, given that backdrop, why don't we move over to Q&A and just see what the chat has on its mind today?
Well, why don't we continue with Japan? We talked a lot about European markets, but how is the Japanese market? Are we really correlated to the US markets, or is it another opportunity for diversification?
So a couple thoughts there, and I'll turn it over to Michelle for some of her thoughts there on the yen and what that's doing to the Japanese stock market. So Japan is a manufacturing-based economy to a large degree. They make stuff and ship it around the world. In fact, one of the interesting aspects of the trade war is that Japan actually makes far more cars in the U.S. for the U.S. market than it ships to the U.S. I think 4 or 5 times as many cars made here for the U.S. market than it makes in Japan and ships to the U.S. market. So it's somewhat insulated in that sense more than many other car makers when it comes to potential for tariffs. But it is still a manufacturing-based economy, so it's going to swing with the manufacturing economy. That's been weak in the last couple of years. We're seeing a recovery in manufacturing, although it's early signs. You know, the PMI for manufacturing is a little bit above 50, barely globally, and so but it's on the rise, and I think generally correlates with continued rate cuts by other central banks around the world as demand for manufactured goods picks up. So all that bodes well for earnings for Japanese companies, which are near all-time highs, and continue to move higher. So that'll be a key driver. Japanese stocks aren't particularly expensive. In fact, on a price-to-book basis, some of them are still rather inexpensive. So you've got relatively reasonable valuations there and some momentum on earnings and much better economic growth forecasts this year than we've seen in a while. But sometimes the currency rise in Japan can act as a little bit of an impediment. Michelle, take us through that.
As you mentioned, a lot of Japanese companies are exporters, and a rise in the yen would make them less competitive. And so a rise in the yen reduces their earnings, either because the translation impact or because they might lose some market share. And so, yeah, when the yen is going up, Japanese stocks tend to struggle, and that's what we've been seeing so far this year. The yen has moved a lot. We'll see if it can continue at that pace. But yeah, the underlying fundamentals for Japanese stocks are really strong. I believe Warren Buffett actually increased his position even more recently.
Oh, good point. Yeah, I forgot to consider that. That's true. We continue to see that increased allocation among some pretty smart investors. You said translation effect. I'm just going to translate what that means. So when a company has a lot of sales overseas and they bring them home, of course, they have to report them in domestic currency, and the yen is up 6% this year versus the dollar. So if you've got a lot of sales in the US, which Japanese companies do, Sony, Toyota, etc., those come back to Japan, they buy fewer yen, right? So it kind of, with the yen up 6%, kind of shaves 6% off of those gains. So when you look versus a year ago or even a quarter ago, that can act as a little bit of a drag. Let's say a 10% earnings growth, but 6% increase in the currency, well, it's going to just translate into 4% earnings growth, right? So it's a little bit of a drag on the growth picture. And as you know, obviously, if you have sales overseas, well, maybe the cost of your product has gone up in local terms to that other economy. So a variety of factors where the yen can act as a particular drag. We tend to like a rising currency overseas when we invest overseas because it just translates into more gains, but it can act as an impediment to the earnings and the growth of those companies. And that's something we've seen this year with somewhat lackluster performance of Japan relative to Europe, in part because of that drag from the currency translation effect. So thanks for all that, Michelle. What else are we hearing from the chat there, Heather?
Well, as a follow-up to that, given the disconnect between central bank policies, the disconnect between the way the yen's moving versus the dollar, are we expecting the markets to move together or separately? So is the US market going to move in the same direction as the Japanese market, or are they going to go opposite?
So far, they've been going pretty opposite this year, and in fact, for part of the fourth quarter as well. And in fact, fourth quarter, right after the election, they really kind of went in opposite directions, where the U.S. outperformed, international underperformed, and then of course that began to reverse just as it did right after Trump's election in his first term. Right in late 2016, international stocks really slumped. China in particular really did poorly, and U.S. stocks did well. And then as we turn to the first year of Trump's term in 2017, that reversed and Chinese stocks really did well along with international and the US lag. It's exactly what's happening this time. The difference is then US stocks were at least up. International stocks outperformed, emerging market stocks outperformed even those, and then China was the best performer. We're seeing somewhat similar this year, except US stocks are down because of the valuation gap between international and US stocks and the earnings revision difference. Remember, the last, I didn't include the chart this time, but our last show, and you can go back and check it out on YouTube, we showed a chart where almost every week this year, earnings revisions for international stocks, or Europe in particular, were getting revised higher, even as U.S. Earnings expectations were revised lower. So as long as we continue to see improving economic momentum in Europe, improving earnings growth in Europe, and much more attractive valuations, then yes, I think we can see a gap in relative performance continue to widen. However, and this gets back to my comments at the beginning of the call, sort of this idea or the show this idea of, when the U.S. catches a cold, or U.S. sneezes, the rest of the world catches a cold. There's only so much decoupling, I think, that can happen between the world's largest economy and others. Maybe more than we've seen in recent years, but I'd note that should the U.S. slide into a recession, it would be hard for Europe and Asia just to continue to advance in their stock markets and their economic performance. You'd probably see a leveling off of the performance there. That's not our forecast. We're not forecasting a recession, maybe just a weak spot in the economy here, and a slowdown below trend growth in the U.S. Likely this year. That's the forecast of the consensus of economists, our own outlook, the outlook of the IMF, the World Bank. So not a pretty much a consensus view that seems to be unfolding. Yet at the same time, improving growth in Europe and Asia seems likely even in that scenario. So a recession would mark maybe markets would perform very similarly, but I think what we're seeing is more of a slowdown in the U.S., and that can still allow international markets to continue to advance and perform well, a continuation of maybe what we've seen so far this year.
Jeff, I wanted to add something there. I totally agree in terms of the U.S. catching a cold, the rest of the world can see some slowdown. But I think it's also important to think about where we were coming into this year, not just in that short chart of, the past decade, but like if you look at valuation, the S&P 500 was at 22 times next 12 months earnings. Europe and EVA were 14 times. So expectations and valuations were high for the US and just the opposite for international. So that's also helping returns this year.
Yeah, I thought when you said the relative positions, I thought you were even going to talk about the economy. This is super important. Germany's been in and out of recession every other quarter for the last 2 years, right? So finally seeing some growth. It's not like everything was growing and now the US is slowing and everything else continues to grow. It's the opposite. Really, what we saw was that manufacturing, what we call the cardboard box downturn, really weighing on international markets, more manufacturing-based economies like Germany, like Japan. Now that started to turn around. They're picking up momentum. The U.S. is a more service-based economy, a lot less manufacturing exposure. So now that services are slowing down, the U.S. is seeing that. So it's natural in a way that we're kind of seeing the two major portions of the economy, manufacturing and services, kind of moving out of sync with each other. And now manufacturing seeing a little bit of an upturn as services are seeing a little bit of a downturn. It's not unusual to see those two move in opposite directions. That's something we've been used to here for the last 4 or 5 years, really since actually even before the pandemic, something we began to experience in 2018 and 2019 as well, with the tariffs kind of pulling down manufacturing as services picked up. Then the pandemic really pulled back on services because we couldn't go or do anywhere or do anything, and manufacturing boomed. And then after that, people started traveling again, so services picked up, manufacturing slowed down, and now we're seeing the reverse of that again. So those two have been moving kind of in and out of kind of out of sync with each other for really the last 5, 6, 7 years, and we're seeing that unfold now. So that's why it's not unusual to see that international picking up at the same time the U.S. is slowing down a little bit. Yep, great point.
In relation to that, you mentioned the German economy is very export dependent. So it is Canada. Now, as we see manufacturing and then services and then go back and forth, do we expect more volatility in that area, or do we expect a break on that trend?
Well, so manufacturing is inevitably boom bust. Services tends to speed up and slow down a little bit more gradually. Historically, manufacturing tends to swing a little bit more abruptly. We're going to watch the data very carefully, and it looks like we're coming off a long lull in manufacturing activity of a couple of years. So inventories have been drawn down, and we're starting to see production pick back up again. And obviously, there's some industries that are really going to see a major pickup, like infrastructure and defense, but others are coming along with that as well. Germany is certainly going to be part of that increase in infrastructure and defense spending. That's literally what they're voting on approving here. Big money. We're talking about 500 billion euros in terms of new spending initiatives. Another, maybe 1% per year of GDP being spent on defense across Europe. So these are some really big numbers that are kicking in that can really help to drive faster economic growth. So all that's kind of playing in. That said, it's not inevitable that it will eventually slow down. And I don't know if that's going to be later this year or next year or the year after, but we'll be keeping a close eye on it. These trends in manufacturing tend to be signaled by the PMI survey. It's one of the reasons why I call it my desert island piece of data. They do a really good job of predicting trends even up to 6 months in advance of actual economic data. So we're not seeing any slowdown in that data yet. In fact, continues to point to increasing momentum, and it tends to follow the shifts in central bank activity. As long as we continue to see rate cuts in Europe, and we are, probably another 2 to go this year, that is also usually leads the PMI and other manufacturing activity by about 9 months. So we've still got a pretty good lead time here of 9 months to a year ahead of us here of improving momentum in manufacturing based on these indicators that have worked very well in the past. There can be no guarantees, but that's what we continue to look at. That's why I continue to favor those more cyclical areas when it comes to investing. Michelle talked about financials. Financials are our favorite sector in the US, but even internationally, we're seeing international financials outperform US financials. It's a very cyclical area. Industrials, obviously tied to manufacturing, materials, energy, those areas are doing quite well this year.
Thanks so much, Jeff. There is one final question that we have. One of the risks manufacturing, of course, are the Trump tariffs. Do we see any escalation based on the fact that Mark Carney, the new PM, visited Europe rather than the US for his first travel? And might that escalate things with the United States and Canada?
Yeah, well, certainly a lot of leaders are seeking out new trade agreements. I think the UK and New Zealand are working on a new trade agreement this week. So there's a lot of movement towards establishing new free trade agreements around the world to try and stop the spread of any tariff war. But yeah, Carney is certainly much more opposed to the Trump administration, more carrying on the Liberal Party in Canada. It's still a ways before we don't actually have. Maybe I missed it, and Michelle, you can correct me on this. I don't think we have a date set for the Canadian election yet. I know it has to be done by like October 5th or something, but I don't think we have a date for that yet. But that will be important. And while the Liberal Party has certainly picked up sharply in the polls with new leadership under Carney versus Trudeau, it's still pretty much neck and neck with the Conservatives led by Pierre Poilievre. So we'll have to see how that election shapes up and what the relationship between Canada and the U.S. will be. It's been pretty antagonistic, and it may stay that way. So we'll have to watch and see how that shapes up. Obviously, many leaders around the world are recognizing that the U.S. is going to be maybe pretty tough on tariffs. We've got this April 1st, April 2nd date where we're going to get a report. And then the OMB is probably going to take 90 days, and then maybe they'll roll out more tariffs on Europe and other places. So over the next, the second quarter, we may see even broader tariffs out of the Trump administration. And I think you see a lot of the world's leaders kind of bracing for that and making sure that they are not encountering those same types of tariffs in any other trade agreements that they have around the world, trying to really isolate the U.S. and really maintain that as sort of the sole area where tariffs are going to be going up, and trying to offset that with some tariff cuts elsewhere. But we'll see what happens. It's a long time between now and even April 1st or 2nd when the next round of tariffs are to be discussed with some of the key reports coming in. So we'll see how that shapes up. Obviously, personalities and politics are going to have a major impact here on the markets here in the first half of this year, and probably all year, as we've been talking about. I think last year we talked repeatedly about the sweeping elections around the world and the impact that that would have on economic policy in 2025. So all that seems to be shaping up as expected, and that means a lot of volatility for markets. Well, thanks for those questions. Thanks, Heather and Michelle, our producers, Andrew and Gabe, and everyone for the questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. And be sure to click like on the show and share your comments on what you're watching in the markets. And we'll be sure to see you again next week.